Bismillahirrahmanirrahim. Subject is financial management. In today's lecture is on efficiency ratios. In today's lecture, we will discuss efficiency ratio. What is efficiency ratio? Efficiency formula. Then efficiency ratios will be explained with the help of illustrations. Then efficiency ratios and illustration, it will be explained with the illustration. First definition, then formulas will be discussed, then we will explain this with the help of numerical questions. Then efficiency ratio interpretation and discussions will be briefly explained or discussed in this lecture. Efficiency ratio is our activity ratio. Efficiency ratios are also called activity ratio as well. These two terms are used interchangeably. If you are asked to calculate activity ratios or you are asked to calculate efficiency ratios, it means one and same thing. So what are efficiency ratio? What it shows? It is basically convey efficiency ratios conveys that the company is how much efficient in utilizing its resources or its asset to generate sale or to generate revenue. So efficiency ratios provide information about how will the company, how efficiently the company is using its resources or assets to generate sales or to generate revenue. Then efficiency ratios are those calculations or those metrics that are used in analyzing the company's ability to effectively employ its resources such as capital and asset to produce income. As I told you earlier that this ratios, the efficiency ratios is all about the company efficiency or the company efficiency in using its resources for generating revenue. Company efficiency in using its resources. Resources for what? Resources for generating revenue. Means resources for generating revenue or generating sales. So efficiency of the company in using its resources for generating revenue. That efficiency ratios conveys information of the company about this phenomenon. So different efficiency ratio focus on different area of the operations, such as how will the company manage its assets, cash flow, and inventory. But in this case, mostly focuses on in efficiency ratio, we focus on current asset utilization. Current asset utilization, not long-term asset utilizations. So main focus is on utilizing our current resources, our current assets to generate the revenue. So analysts typically screen through the company's financial statement. What they are screening: balance sheets and income statement. These two things are used by analysts to aggregate the number of efficiency ratios calculation. What we will use an efficiency ratio calculation, that is some numerical figure are extracted from that of income statement, cost of goods sold statement is used. Current assets from balance sheet, current liability from the balance sheets. These figures are needed for efficiency, for calculating efficiency ratios. Efficiency ratio, ratio of single firms do not convey any message. It is of no use. Broadly speaking, all ratios, when it is used in comparison with the other companies or industry or with its earlier periods, accounting period, then the ratio is useful. For example, we calculate some ratios and we compare it for 1, 2, 3, 4, and 5. And ratios are compared, let's suppose, of these 5 here, we will get trend, we will get that how much fluctuations are occurring in our these efficiency ratios. But at the same time, if these ratios are compared with peer firms are industry overall industry averages, then it will show the company's show the company position that either it is doing better in use of its resources in order to generate the revenue. So it is good to compare efficiency ratios with peer companies in the industry as well as industry itself to get insight into how the company perform relative to its competition or its competitors. Efficiency ratio and profitability ratios are highly correlated. Efficiency ratios and profitability. In coming lecture, we will discuss profitability ratio. When companies efficiently allocate their resources, they become profitable. So when best utilization of resources result in profitability of the company. Inventory turnover ratio. First, we will discuss inventory turnover ratio. Inventory turnover means the number of times an enterprise sell out its stock of goods with a given period of time. Means, let's suppose if we are studying 1 year periods, one accounting period, 1 year, and we want to calculate that how much frequently we are our enterprise is using its how frequently the enterprise is using its inventory over the given time period of time. So inventory turnover ratio is calculated as cost of goods sold divided by average inventory. What is average inventory? Average inventory means you will be provided with 2-year data. Let's suppose 2018 and 2019. So inventory will be provided for the 2 year, for 2018, for 2019. Now average inventory means by adding these two inventory to figure of the inventory of the 2 year and then it divided by 2. Let's suppose here is 40 million and here is 20 million inventory with the company. So what will be the average inventory? 40 plus 20, we will get 60 60 divided by 2 equal to 30 million inventory. 30 million inventory. So average inventory cost of goods sold will be for 2019. So if inventory is not available for the both year, you may use inventory of that specific year for which you are going to calculate inventory turnover ratios. As I discussed that it is also common that used sales is a numerator. Sometimes cost of goods sold is not available. So inventory turnover ratios, some other use sale as well instead of cost of goods sold. Since the only difference between sale and cost of goods sold is markup, that causes no problem. The inventory turnover ratio measures the number of dollars of the sales that are generated per dollar of inventory. If we use sales, it will provide us that how much inventory we are holding or how much investing we are holding in we are holding in inventory, holding investment in inventory, and how much it generate sales. So we can use some other use sale instead of cost of goods sold means even if inventory for the 2 years are not available, then inventory for that specific year may be used as a denominator. Second ratio is account receivable turnover ratio and efficiency ratio. Account receivable ratios evaluate the efficiency of revenue collection. How frequently the company is collecting its receivable from its credit sales. Account receivable ratio conveys or it is about that how frequently the company is going to collect its account receivable from the customers. Account receivable can be calculated as net credit sale divided by average account receivables. Again, what is average account receivables is I told you earlier that if we have 2 years, that is 2018 and 2019, we will provide it. Let's suppose we have 10 million account receivable in 2018 and 15 million and 16 million, let's suppose, in 2019. What will be average account receivable? We will add both 10 plus 16 divided by 2, which is equal to 13. So this is how we will calculate average account receivable. If data for the 2 years are not available, then account receivable of that specific, let's suppose if this 2018 is missing, we will use simply this 16 million instead of average account receivables. Net credit sale are sales where the proceeds are collected at later point in time. We will exclude all cash sales. So net credit sales on credit minus sales return minus sale allowances. Sale allowances means discount allowed to the customer. So cash sale will not be included in our numerator. Average account receivable is the sum of starting, is I discussed it earlier, starting and ending account receivable balances over a time periods, monthly, quarterly, or year divided by 2. Account payable turnover ratio. What is account payable turnover ratio? Account payable turnover ratio is that how frequently the company is paying its outstanding amount or its obligation to its suppliers. Account payable turnover ratio represents average number of times that the company pays off its creditor during the accounting periods. The ratio also serves as a measurement of short-term liquidity. A higher payable turnover ratio is favorable. It enables the company to hold cash for a longer time periods. For example, if we pay, there are two companies, one pay in 30 days and other pay in 60 days to its suppliers. 60 days. Let's suppose this is A company, this is B company. B company enjoys an extended credit limit from its supplier, while A company is just achieved 30 days credit limit, so B will have more liquidity instead of A because it is not bound to pay to its supplier in 30 days. It's bound to pay its supplier in 60 days. So extended period is favorable for the company in accounting in account payable turnover ratios. Account payable turnover ratio is equal to net credit purchases divided by average account payables. Net credit purchases are only the purchases made on credit. Cash purchases will not be included. Alternatively, since number for the net credit purchases is difficult to find, not difficult but it involves calculation, analysts often substitute cost of goods sold as numerator instead. It means sometime if you don't get net credit purchases or you don't have any information about net credit purchases, you use cost of good sold, CGS, cost of good sold, instead of net credit purchases. Average account payable, as I discussed earlier, that if 2-year data is available, then calculate, add the 2-year data and then divided by 2. Account payable for the first from the earlier year and account payable for the current year, and then add up them and then divided by 2, you will get average account payable, as I told you in the earlier portion of the lecture, that how it will be calculated. Asset turnover ratio, that is long-term asset turnover, that how much the company is efficiently utilizing its total assets in order to generate revenue or sales. It compares the dollar amount of sales or revenue to its total assets. The asset turnover ratio calculated net sale is a percentage of the total asset. It means that how much company in holding, let's suppose if one company is holding 1,000 million assets and it generate 100 million sale, that is, let's suppose A company. B company hold the same assets, 1,000 million asset, but it generate 120 million sales. So B is better than A because implying same amount of asset, investing in same amount of asset, holding same investment in the total asset. B company generate high sale while A company generate a bit lower sale than B. So B is in better positions. So account payable turnover, sorry, it is not account payable turnover, it is asset turnover ratio. There is typo. Asset means total asset, turnover ratio is equal to net sales, it will include wholesales, not credit sales, divided by total assets. This is the formula. Total asset. Not this one means asset turnover ratio is equal to net sale divided by total assets. Net sale divided by total asset of the firm. It is asset turnover ratio. Net sale means sale minus sale discount and sales allowances. Average total asset means if we have 2-year data, then total asset at the end of the period, total asset at the beginning of the period divided by 2. Means if we have 2018 and 2019 2-year data, we can easily calculate it. If total asset is 1000 here and total assets in 2019 is 15,000, then 1000 divided plus 15,000 divided by 2, it will give us a total average total assets. Moving further, day sales in inventory. It means that how much for how long we invest or amount in the inventory, or in other words, how the company frequently convert its inventory into cost of goods sold, or frequently in sales. In other words, it measures the number of days it will take the company to sell all of its inventory. In other words, the day sales inventory ratio shows how many days the company current stock of inventory will last, means how frequently or how much days it will take that we will convert the amount of stock is shown in the balance sheet into cost of goods sold or in sales. Day sales in inventory is equal to days in year are 365 divided by inventory turnover ratio. We will get the number of days. It measures value, liquidity, and cash flows. Both investors and creditor want to know how valuable the company inventory is. What it shows? It shows because inventory is converted into sales result in cash flow. When inventory is converted into cost of goods sold, it shows liquidity, that the amount held in inventory will be converted into cash. It shows the value of the inventory as well, that the company have no slow moving item, have no obsolete item, have no damaged item. It is valuable inventory and can be converted into cash, and it shows the liquidity of the company. Investor and creditor want to know how valuable the company inventory is. Now, older, more obsolete inventory is always worthless, as I told you earlier, than the current fresh inventory. The day sales in inventory shows how fast the company is moving its inventory and converting its inventory into cost of goods sold or into sales. Day sales outstanding. Day sales outstanding is the average number of days that receivable remain outstanding before they are collected. It shows that it shows in days that much time will take that the company account receivable will remain outstanding. Day sales outstanding is equal to days in year are 365 divided by account receivable turnover ratio. What are the usage of account days of this ratio, days sales and outstanding? It determines the effectiveness of the company's credit and collection effort, and allowing credit to the customer as well as ability to collect from them. It shows the effectiveness of the company. What effectiveness? That how it is effective in collecting the amount from the customer. Secondly, that it allow credit to the customers, and then its ability as well as also show the ability that the company is able and have a capability to collect the amount from the outstanding amount from the customer on time. We cannot say that 30 days collection period is good, 40 days collection period is good, or 60 days collection period is good. So there is not an absolute number of days sales outstanding that represent excellent or poor account receivable management. As I told you earlier, that in single ratio do not communicate anything to the investor or to the analyst. When we compare it with the other peer firms or with industry averages, then we will be able to give an opinion that the company is doing well or doing are performing slower or lesser than their peer from our industry or all industry averages. So account payable turnover in days. Account payable turnover in days shows average number of days that payable remain unpaid. Means if there are 60 days account payable turnover and day we calculate that it is 60, it means that we have 60-day or we are enjoying 60-day credit limit from this from our supplier. To calculate account payable turnover and days, simply divided 365 by payable turnover ratio. Account payable turnover ratio in days is equal to 365 divided by account payable turnover ratio. Efficiency illustration. I got a balance sheet, 2-year balance sheet, that is June 30th 2009 and June 30th 2010, as one of the cement company in our region called Cement Company Limited. It is authorized capital, which is this one. Authorized capital do not add or subtract to the balance sheet. Issue subscribed and paid-up capital, reserves, accumulated profit. Then we are, for this specific illustration, we are interested in account, trade and other payables, which is called account payable. Interest and markup accrued, we are not interested in. Short-term borrowing, current portion of non-current liability, we will use this figure. These are not used in account in efficiency ratio. Long-term financing, liabilities against asset subject to lease finance, long-term securities, deposit and retention of money, deferred liabilities, derivatives, financial liabilities. We will not use this portion here in this lecture. So only account payable will be used from liability side. So we have 2-year account trade and other payables for the 2 years. this one and this one. So when we calculate average account payable, we will add both the figure and will divide it by 2. From asset sides, we will not use these assets, tangible and intangible. We will use stock and trade, which is called inventory. Trade debt means account receivables. Cash and bank balances, deposit, prepayment, and other receivables. But we will use these 2 for efficiency ratios, these 2 current assets. And then we will also use this total current assets for overall asset turnover ratio. We will calculate it as these 2 plus divided by 2, we will get average turnover ratio. This is income statement. So in income statement, as I told you earlier, we will use this figure, net sales, cost of goods sold, maybe sometime, I guess these 2 things are used in this efficiency ratios. Now efficiency ratio required: calculate inventory turnover ratios, account receivable turnover ratios, account payable turnover ratios, day sales in inventory, day sales outstanding, account payable ratio in days. Now inventory turnover ratio, cost of goods sold divided by average inventory. Is I told you earlier that average inventory is calculating by the inventory of the 2 year divided by 2. So by plugging value in the above formula for KUST Cement Company Limited, inventory turnover ratio as this figure comes from cost of goods sold statement, income statement, divided by average inventory is calculated, that is 15.555. But again, the single ratio do not communicate nothing. We will when we are comparing it with the other firms, we will assume that the other firm are operating in the same sector, same industry, and same geographical area. Account receivable turnover ratio. Account receivable turnover ratio is equal to net credit sale divided by average account receivables. Plugging value in the above formula, we get, but we will plug this value from the balance sheet and income statement of the KUST Cement Company Limited. Account receivable turnover ratio is credit sale divided by average account receivable, which is calculated. So it is 195.333. The single ratio do not communicate us any opinion making information. But when we will compare it with the other firm, we will assume that the other firms are operating in the same sector, same industry, and same geographical area. Account payable ratio. Net credit purchases, not cash purchases. Again, the words credit is mandatory. Net credit purchases divided by average account payables. By plugging value in the above formula, we get KUST Cement Company Limited. Account payables turnover ratio is equal to net purchases divided by average account payables, which is 4.3 or 4.707. Again, this single we cannot make any opinion about this single ratios, but it shows that 4 times means 4 times we are going to pay in a year to the suppliers. Now days in inventory, days inventory turnover, day sales in inventory 365 divided by account inventory turnover ratios. Plugging values for quart cement companies, day sales in inventory is equal to 365 divided by 15.555. This inventory turnover ratio has already been calculated. So we get 23.46 or 24 days. It means that it took 24 days to convert our inventory into cost of goods sold. To convert our inventory into sale, it took 24 days to convert our inventory into cost of goods sold or into sale figures. Now day sales outstanding means 365 divided by account receivable turnover ratios. Plugging value we get for Quart Cement Company Limited, day sales outstanding is equal to 365 divided by turnover ratio, which is 195.33. It took 2 days to collect our receivables. It took 2 days to collect our receivables or to convert our receivables into cash. Account payable ratio in days, 365 divided by account payable turnover ratios. By plugging value in the above formula, we get for Quart Cement Company Limited that account payable ratios in day is equal to 365 divided by 4.707. Means we pay to our suppliers in 77 days. We enjoying a higher credit limit. Means the Quart Cement Company enjoying a higher credit limit. This is all about today's lecture. Thank you.